Hello, my name is Gwen Lohman. I am from the University of Denver, and my co-author of this study was Irina Kindanova, a professor at the University of Denver. And our paper focused on the effects of exchange rate on US companies' investments from the year 2000 to 2020. So the study attempts to answer the question, how do exchange rate movements affect US top importing and exporting companies' investments from the 2000 to 2020 year time period? So the traditional view of currency appreciation is that it will actually decrease investments. And so the process of this looks like one, currency appreciate, demand for exports decreases because domestic goods are less expensive, leading to a decline in exports, revenues declining, and then investments decreasing. But this study attempts to kind of explore this new area in which currency appreciation actually could lead to increased investments. And the process for this looks like when currency appreciates, imports become cheaper, leading costs to decrease, profits to rise, and therefore investments to increase. So to begin this study, I started with a literature review to have a better understanding of previous studies' findings. Looking at exchange rate volatility and trade as a whole, most studies found that an increase in exchange rate volatility led to a decrease in international trade. And this has to do with essentially the risk associated with exchange rate volatility, in that some companies don't know if they can withstand this risk or when currency appreciates or depreciates, and therefore they will decrease their trade. Looking specifically then at the export channel, the biggest finding was that nominal exchange rate volatility was insignificant on exports, but real exchange rate volatility had been found to have a negative effect on exports. And this was prevalent to this study because we then used the real effective exchange rate rather than the nominal exchange rate. And then lastly, for the import channel, the major finding was that exchange rate volatility had shown to have a negative effect on imports. And this was similar to kind of the overall theme of exchange rate volatility and how that depresses trade overall. And so we used two guiding papers for this study. The first was by Lee that looked at Korean firms. And he found that when the Korean won appreciates, the import channel was statistically significant in increasing a firm's investments. Similarly, a study by Ho Tai looked at Japanese firms, and he saw that when the import ratio was higher and the real effective exchange rate increased, investments significantly increased. Similarly, what he included in his study was he looked at a company's previous quarterly investments. And so we decided to look at that in our study as well. And when he was looking at this, he found that an increase in previous investments decreased current investments. So this is the baseline model that we used in our paper. So what this equation is showing here is it's looking at a change in investments considering the previous 4-quarter investments, the real effective exchange rate, the market power, and the bank prime lending rate. So the markup was calculated by taking the operating profits divided by sales. So when we're using this traditional view, we would expect that beta 1 would be negative because when the US dollar appreciates, we would expect that investments would decrease. Additionally, we would expect beta 2 to be negative as well because when the bank prime lending rate increases, financing costs increase, which results then in a decrease in investments because there's less money to be spent on investments. So then we decided to look specifically at importing companies' investments and exporting companies' investments. So here we can see then it's the same equation essentially, but now we're looking specifically at these importing companies. And in this equation, then we would expect beta 1 to be positive with this exploration area of the study because we're believing that when the US dollar appreciates, importing costs decrease, which allow profits to rise and therefore an increase in investments. Then here in this equation, we're looking specifically at exporting companies. And with this traditional view, then we would expect beta 1 here to be negative because when the US dollar appreciates, demand for exports then decrease. So the companies included in this study were found from a list of the top US importing and exporting companies of the 2020 year based on a 20-foot equivalent unit, which is essentially a shipping container. So there were 62 US public companies included, of which 39 were importing companies and 31 were exporting companies, and 8 of the companies were listed in both groups. The independent variable of this study was investments, which we measured using the change in property, plant, and equipment. But because we were using the real effective exchange rate, we needed to use real investments, which we calculated by taking investments divided by the inflation index. So now going over the results, just to explain this table a little bit, the first 4 rows here are the log of the previous quarterly investments. So quarter 1, quarter 2, quarter 3, and quarter 4. This row here looks at the log of the real effective exchange rate, and this row here looks at the log of the bank prime lending rate. So when considering the entire sample, we can see that the real effective exchange rate coefficient is negative, but it's statistically insignificant. The bank prime lending rate, on the other hand, coefficient is statistically significant and positive, meaning when the bank prime lending rate increases, so will companies' investments. And then we can see also that all 4 previous quarterly investments are statistically significant, and the first 3 previous quarters are negative, meaning if a company had invested in one of these 3 quarters, then their current investments would be lower. Now looking specifically at the exporting companies, we can see that the real effective exchange rate, again, is statistically insignificant. The bank prime lending rate here is statistically significant but negative, meaning when the bank prime lending rate increases, exporting companies' investments will decrease. And then we can see that the previous quarter 1 and previous third quarter are both statistically significant and negative. Now specifically looking at importing companies, the real effective exchange rate here is statistically significant and positive, meaning if the US dollar appreciates, importing companies' investments will increase. We can see here that the bank prime lending rate is also statistically significant and positive, meaning when the bank prime lending rate increases, importing companies' investments will increase. And we can see here that previous investments in quarter 1, 3, and 4 are all statistically significant as well. We then further divided up the data looking at domesticity, so whether a company was headquartered in the US or not. So considering domestic exporting companies, the real effective exchange rate again is statistically insignificant. The 2 previous quarter investments are statistically significant and negative, meaning if they had invested in these 2 quarters, their current investments would be lower. And then the bank prime lending rate is statistically significant and positive. For domestic importing companies, we can see here that the real effective exchange rate is statistically significant and positive, meaning that when the US dollar appreciates, domestic importing investments will increase. The 2 previous quarter investments are both statistically significant and negative, and the bank prime lending rate is statistically significant and positive. And then lastly, for foreign subsidiary importing companies, the real effective exchange rate here is statistically significant, but it's negative now, meaning if the US dollar appreciates, foreign subsidiary importing investments will decrease, and the bank prime lending rate is now statistically insignificant, whereas the 2 previous quarter investments here again are statistically significant and negative. So just to recap the findings, we found that when the US dollar, looking specifically at importing and exporting companies, we found that when the US dollar appreciates, top US importing companies will increase their investments. Considering domesticity, we found that importing companies headquartered in the US will increase their investments when the US dollar appreciates, but importing foreign subsidiaries will actually reduce their investments when the US dollar appreciates. Previous investments, it was typical that when a company had invested in one of the previous 4 quarters, this would actually hurt their current investments, meaning they would be lower. And then for the bank prime lending rate, it was found that the bank prime lending rate was statistically significant and positive for both importing and exporting companies. And this can be explained through the fact that when the bank prime lending rate increases, this could be actually a signal that the economy is doing well. So it would make sense that these companies would increase their investments, with the exception of foreign subsidiary importing companies. And this can also be explained through the fact that foreign subsidiaries may have an easier time getting financing abroad. So the purpose of this study was to help further understand U.S. companies' investment decisions. And this is prevalent today because the business world is becoming more globalized. So it's important to understand how the real effective exchange rate may impact companies' investments. For future research, I would suggest attaining a larger sample size, as well as including company industry information, because certain industries may be more heavily affected by the real effective exchange rate than others. Now, here are the resources we use for the literature review in this PowerPoint. There were more listed in the paper. And here is the contact information for myself and Arina Kindanova. And thank you so much for listening, and I hope you enjoyed this presentation.